Now, the U.S. housing recovery keeps rolling on. Take a look at this. The monthly Shiller index found that home prices increased more than 9% for the month of February. That compares to this time last year. That is the largest increase year to year in home prices since 2006. Annual prices rose in all 20 major cities surveyed for the second month in a row, and that is the first time that has happened since 2005. But who had the highest gain? Phoenix, the largest annual gain with a jump of nearly 23%. Now, home prices may be rebounding, but there are still some trouble on the horizon. A new survey now shows home ownership in the U.S. has fallen to the lowest in more than 15 years. I had an opportunity to talk to Robert Shiller, co-author of today's report, and I asked him about if he's optimistic about the survey's results.
I think it'll probably go up this year, but I also don't want to chime in with the enthusiasm that some people are expressing that we're off to the races again. I think we should hold back our enthusiasm a little bit.
In keeping with the theme of holding back our enthusiasm, last time we had you on the show, one of the challenges you cited was specifically the consumer, the jobs issue that likely would have an effect on potentially demand for housing. Has the job market reached a point where it is on a positive trend line, or are there still things we need to worry about with respect to the employment issue in the United States?
Well, the jobs market has been on a positive trend line pretty much since 2009, 2010. So it's been improving, but very slowly. And it's been improving under really intense stimulus from the Federal Reserve, with interest rates at the short end brought down to zero. And now with QE3, with mortgage rates at record lows, amazingly low interest rates. And so I think it may be a good time to buy, not because home prices are going to go up, but more because interest rates are so low.
The recent article from Bloomberg cited U.S. homeownership numbers at an 18-year low, which essentially, for all intensive purposes, means the fewest number of Americans currently now own a home, just around 65%, or roughly two-thirds of all Americans. Is that a bullish sign, or is that a bearish sign for the future?
Well, I think in a way it's bullish, because I think people are kind of locked into their homes. Now, a lot of people aren't moving to take new jobs because their home is underwater. So I think it may reflect kind of a more mobile culture, that it might be a positive thing for the future. Not for home values, but, you know, people seem to want to rent more. And you'll note that multifamily properties have had a higher price increase, according to the CoStar indices, than our single-family or owner-occupied homes are. So I think that we may be switching somewhat toward being a renter nation.
There's been some criticism of the current Fed policy, obviously keeping rates extraordinarily low, as we've talked about. But that also creates a conundrum, meaning that hard assets such as housing potentially could be in another bubble. Do you worry about that?
So there is this artificial stimulus of asset markets, and including notably the housing market, which you know, that often accompanies bubbles. It makes bubbles happen, but I don't know that it's going to last, and whether it will be. You know, we have a whole different mindset now about bubbles. We have now Dodd-Frank and you know, the government agencies that are supposed to prevent them from getting excessive in the future. So the idea that we're going to really be off to the races seems wrong to me with home prices.
Well, Professor, one last question. You know, yesterday the Treasury Department met with a number of business leaders, and I'm sure the discussion of housing has come up. How do you think the Treasury Department views housing and the economic recovery?
My hope would be that we get on to some more reform of markets so that they function better. This crisis was caused by aggressive mortgage lending, and mortgage lending that didn't have workouts planned or have safety valves for people. So I think we need to, I've written about this in a couple of books, we need a mortgage market that is more user-friendly, designed to protect people against falling into the kind of crisis we have now.